We talked about charms, like these, and I would like to convince you the next few minutes that this thing can have its charm as well. Before we get into this, just a very quick reminder of what we do at BWM. We focus on normalized numbers in any environment. So one thing is we try to estimate, calculate what's the normalized earnings power of a company. We want to know what's the normalized valuation that the company would deserve. And multiplying the two gives us our fair value estimate. And usually we assume in 3 years everything is normal. So this gives us the fair value in 3 years' time. We discount that back to today, gives us the current valuation, the current fair price. And we then, of course, back that up also with a discounted cash flow model. And we don't only look at a fair value as a pinpoint, but more as a range. So we do also calculations on certain scenarios. What could go worse than we expected? Might we have been too conservative? With that in mind, let's look at Wienerberger. As the name suggests, that's an Austrian company headquartered in Vienna. They are the world's largest producer of bricks. They operate in 28 countries, that's in Northern America, and here in Europe, basically everywhere except Switzerland. They have more than 200 production sites, more than 20,000 employees, and keep that in mind for later on. The market cap is around about 2.5 billion, a little less than 2.5 billion. The portfolio, what they're selling, what they're producing, covers all kinds of bricks for roofs, wall, facade, surface. They have some water management pipes, and they also have photovoltaic solutions for their roof segment. Can it get any more boring than this? Look at this brick. Can it get any more boring? Well, can it? Let's take a look at the share price over the last more than 2 decades. During the financial crisis, the shares went down by 90%. So the business isn't that boring after all, I guess. We need to understand, can this happen again? What has changed, if anything has changed? We are, again, like in those times, in a recessionary environment on the construction side. Here you see numbers for new housing construction starts in the US. You see this decline during the financial crisis. You saw the recovery thereafter. And the last 4 or 5 years, we are in a declining direction. And again, this year, we are also trending downwards. Let's move over to our side of the pond. This is Germany. New residential building permits, which is a leading indicator for residential buildings. You see the same decline as in the US during the financial crisis, hardly any recovery thereafter. And now for 3 years, and currently we are in the 4th year, where new construction has basically come to a standstill or close to a standstill in Germany. So market aren't looking good for Wienerberger. We can look at those numbers for any kind of market where they're in. Nice enough, the company does that for us. Here you see an index that Wienerberger calculates and publishes themselves. They look at all the markets they're in, all the verticals they're in, and looking at the market volume. And they set 2021 as the base year, as a reference year at 100%. Last year, we were down, volumes were down 35% versus 2021. And we are not seeing a recovery this year. So likely we will stay at this minus 35%. For us, it's important. We know it's a cyclical industry, but with those kind of numbers, we are pretty sure that we are closer to the trough than to the peak. So if at all, we would regard this as a positive picture that eventually there should be a recovery coming. Now let's look at the financials. How's the company faring in those dire markets? Here you see operating profit margins, that's EBITDA. Yes, it has come down a bit over the last few years, but it's holding up pretty well. The company is solidly profitable even in those environments. Different perspective on the same point, free cash flow generation. They are easily profitable. They're making a bunch of money even in those markets. And here you see our forecast for the next few years. And the dip this year is basically technicality. There is a normalization of net working capital. So the numbers thereafter, this is the underlying free cash flow generation. And this is not assuming recovery. So again, keep in mind, we talked about a market cap of 2.5 billion. The company is making 250 to 300 million in free cash flow. How was that possible? What has changed since the financial crisis? In 2007, right before the financial crisis hit, Wienerberger was making 95% of the revenues from the new build segment. That is by far the riskiest and most cyclical end market. Last year, that was just 45% of revenues. And in the meantime, organically and through acquisitions, they have grown their exposure to renovation, that's mainly roofing, and infrastructure, that is mainly water management and piping. Those areas are much more stable over time, and they're also right now holding up much better than the new build. Another thing very important for us, we're looking at the balance sheet. Here you see the leverage ratio, net debt EBITDA over the last 22 years. The company had already some leverage before they entered into the great financial crisis, and then leverage skyrocketed. That's the time when the current CEO took over. He had to do a capital raise. He had to issue 2 or 3 expensive hybrid bonds. But ever since, the whole company basically in their DNA had this near-death experience. And they were focusing on stabilizing the business, making revenues and profits less cyclical, more stable, and delevering over time. So the current crisis was entered with a leverage ratio, a very strong balance sheet of less than 1 times. Now, going forward, what's the earnings power of the company? Here you see in absolute numbers the operating profit over the last 20-some years. And this year, management in their guidance talk has basically given up. They have thrown in the towel. They are no longer talking about any recovery. They are guiding for an EBITDA increase based on no recovery in end markets. This is only the latest 2 acquisitions they've done that will flow into EBITDA, into profit this year, and then also more next year. And certain self-help measures, some cost cutting, some getting more efficient, closing down some plants that are underutilized or mothballing them to be opened later on when the recovery comes. Now, despite being closer to the trough of the cycle than anywhere else, despite a better balance sheet, better quality operations, better quality portfolio, more stable, despite all of that, the company is trading very cheaply today, both on an absolute level as well as on a relatively level with the history. This is enterprise value to EBITDA, a little more simplistic. We can look at the price earnings number. Wienerberger is trading at less than 11 times earnings this year, less than 9.5, I think it's around 9 times earnings next year. They're trading at a free cash flow yield for the next few years of 12, 13, 14%. So even if no recovery is coming, the shares are too cheap today. And obviously, I'm coming to the end here, that's the reason why we own them in our funds. Here you see over the last 4 years the share price performance. The red bars show you when we bought and when we sold a few shares because the stock got too big in our portfolio. And the green line, that's this baseline, the pin value for our fair valuation. And the yellow lines show you the range that we are seeing where the fair value should be. The latest decline in the fair value, that is basically us also assuming the recovery will take a little longer to materialize. So there's upside to all of this if eventually the recovery comes. My last slide, very quickly, those are the 2 funds that we manage. They are very similar. The subtle difference, there are subtle differences, but the main difference is in the 4th line. The classic value can only invest in large cap stocks defined as larger than 2 billion Swiss francs when we buy them for the first time. Now, Wienerberger was larger than that, so we own Wienerberger in both of our funds. With that, thank you very much. easy on me, please.
Very interesting, and clearly a commodity stock, so appealing to me as well. This is just a brick, and they're the world's largest producer of bricks. So what do they do differently than anybody else in the world? What makes them so special? Is it a better product? Is that possible, or is it better service?
I love boring, so it's a boring industry, I understand that. But when you dig deeper into it, it's not that boring. Actually, the important point on Wienerberger and on the investment case is the pure fact that they are the largest producer. Large meaning those more than 200 production sites. Bricks are incredibly cheap relative to the weight, so they don't travel far. It's similar to cement. You have a certain strong market position around your production site, and most of their competitors operate 1 or 2 sites. So when the recession hits, they cannot close them down. They have to produce or give up. And there are certain small players that had to give up. Wienerberger is operating a network of production sites. They can close certain sites, mothball them when the utility is too low, and they can deliver to those markets from adjacent production sites, or also before they mothball it, they produce on inventory so they can deliver for a certain time period. That is, I guess, one of the most important moats they have versus competition.
Thank you. Well, and in a sense, you're talking about management quality, I understand. And when you, on one of your charts here, you were talking about how, even as their profitability was declining, they were able to maintain their margins. And what is your sense of the quality of management overall, that they're pulling different levers?
As I said, the CEO was already part of the management team before the great financial crisis hit, but he was not the CEO then. But he saw what went wrong, and he had to take over in the most dire of situations. Company was close to bankruptcy. And I think it says huge about him and his quality and the leadership that he's pulling after him, what they had done in the next 15 years. Basically totally turning the company around, investing in more stable parts of the business, and the numbers show that.
Terrific, thanks. And then just finally, there's much talk today about molecules versus bytes and tangible assets versus AI assets. And in particular, we've read these reports called HALO. Heavy assets means that they're very low obsolescence. So that's a good thing as an investor. So what's your thought in terms of your stock?
I have difficulties with technology. Very often I don't understand it. This is much more simple. And whatever we are going to do, whatever happens with AI, in the end of the day, when we go home, we need a home. We need to sleep somewhere. We need shelter. Now we can talk about, should that be concrete or clay bricks or wooden structures? That's also a different interesting topic. But in the end, we need those. Whatever happens. I like that.
Now, this is the perfect ending to this kind of conference. Thank you very much.
Thank you.